Hello and welcome to the Manulife Investment Management Asset Class Outlook webinar series. Just a quick housekeeping points before we kick off today. Most of you who joined via the webinar, you can submit your questions during the session. You can do so by submitting questions below the screen. And for those of you who dial in, we appreciate you stay on mute throughout the whole session. We'll endeavor to address as many questions as we can at the end, but if we don't get to yours, our sales team will follow up after the event with you. Our speaker today is Dylan I, Fixed Income Client Portfolio Manager. Over the next 15 minutes, Dylan will give us the outlook of preferred securities. Towards the end, he'll stay and answer any questions you may have. Over to you, Dylan.
Thank you, Daphne. Good afternoon, everyone. Thank you for tuning in today. So for today's presentation, I'll focus primarily on the preferred securities asset class. Obviously, it's been a very volatile period since late February and into March. There's been a number of reasons why we've seen volatility in the marketplace, which I hope to go through and provide some more additional color in terms of which sectors and how they've performed within the preferred securities universe. I'd like to also move on later to talk a bit about where we see valuations for preferred securities currently and why we think based on fundamentals, preferred securities is still a relatively attractive asset class at this point in time. So if I turn to slide number 3, just to focus on the asset class performance, the numbers here show performance year to date and month to date up until the 20th of March. So for preferred securities, it was around minus 19.9% year to date, and that compares with global high yield at minus 19.26% and US equities at minus 28.3%. We've obviously had a bit of a rally in the last week or so, and that's actually taken the market up a little bit. So we've recovered around 10%, and year to date performance for preferred securities is around minus 12%. Up until the 27th of March. So if we break down the performance, we can see, in terms of the retail preferred securities, they pretty much led the sell-off, and there was a bit of a differentiation between the retail par $25 preferred securities versus the institutional $1,000 par securities. So retail preferreds were down minus 21.8%, while the institutional par preferreds were down minus 14.09%. The next chart really shows the difference between the blue line and the green line. So again, the blue line just highlighting the fact that the retail preferred securities underperformed during this period. And the reason for that is because during the initial market sell-off, we did see retail ETFs in particular that follow the preferred market in the US, face fund outflows during this time. Consequently, we saw a lot of the retail $25 par preferreds sell off initially harder than the institutional $1,000 par preferreds. Now, just to give a bit more background in terms of the sell-off, I think there was, two main reasons why preferred securities, was faced with such volatility, since the end of February. The first reason, which I'm sure all of you are familiar, is with the spread of the coronavirus. Initially, global investors were thinking that this, optimistically thinking, perhaps that the situation could be isolated to Asia. But obviously, as we saw the negative news that the coronavirus was spreading, first of all to Europe, with countries such as Italy and Spain being hit hard, and then later on the US as well, now taking over, China in terms of the number of affected patients. We've seen that markets really reacted in a very strong way, and we saw, a very rapid sell-off. Unfortunately, preferred securities being a risk asset class, did sell off, along with other asset classes such as, US credit and US equities. The second point to note is really, what drove the sell-off was that in early March, there were discussions between OPEC, led by Saudi Arabia, with Russia, and they were, entering talks to talk about potentially limiting the output for oil production, which would, give the oil price some support. Unfortunately, the talks between the two countries fell apart in early March, and we did see a pretty violent reaction to the oil price. So, before the talks, the oil price was trading, around $60 US. But since then, they've really taken a beating, and they're currently around, below $30 US per barrel. So that's actually a year-to-date decline of around 60%. So we found that, as a direct result of the oil price coming down, we have seen US credit, as well as some of our preferred names that are, in the energy sector, sell down consequently as a result of the failure of the talks between Saudi Arabia and Russia. If we look at the next slide, we can break it down by the different sectors and how they've performed, again, up to the March 20 period, year to date. So straight away, you can see that energy was actually one of the worst sectors, falling by 28.8%. The consumer cyclical also has been doing quite, relatively worse, minus 22.3% over the same period. And that's because, again, it's due to the impact and the uncertainty around the coronavirus and how that's going to be impacting growth sectors, including the consumer cyclical sector. Other more defensive sectors, such as the electric utility sector, have actually performed slightly better at minus 8.95%. But pretty much you can see that, most sectors were, negative during this period, and, no sector was spared. The other point I'd like to make here is that because the market reaction was so quick, again, due to the two main negative factors of the coronavirus and the collapse in the oil price, within the energy sector, for example, we did see the sell-off, within preferred securities. And the sell-off was pretty much indiscriminate. We didn't really see much differentiation between different names in the energy sector. So as you know, within the energy sector, you do have your downstream company, upstream company, and midstream company. And typically the upstream, E&P producers are usually the most volatile, as their exposure to the oil price is the most direct. But even within the midstream sector, where typically the direct link with the oil price is not as big, we did see preferred securities, nonetheless sell off, even though they are, midstream companies. So just really wanted to highlight the point here that because the reaction, from the market was pretty much headline driven, we haven't seen that much differentiation. And, within the preferred security universe, we did see a sell off, across, all the different sectors, including energy. The flip side to that is if we look on the chart on the right-hand side, we do now see that valuations are quite attractive from a yield perspective. So within the energy names, you can get, on average, the YTM or the yield to maturity is around 8.5%. Consumer cyclical is similarly quite high at 7.8%. And even if we consider more conservative or defensive sectors such as electric utilities, we're still getting quite an attractive yield around 5.6%. So if I skip to the next slide, number 7, looking at the valuation, another way to think about it is actually to focus on credit spreads. So the chart on the bottom left is really looking at what the historical credit spread has been for institutional preferreds, going back all the way to 1997. And over this time, the average credit spread has been around 2.8%, or 277 basis points. But currently, the credit spread in the institutional space is around 4.8%. So clearly, we are seeing quite an attractive valuation compared to history in terms of where spreads are at the moment. In fact, if we look back, the only time where spreads have exceeded the current level is during the financial crisis of 2008, 2009, where the credit spread actually approached around 9%. But since then we really haven't seen spreads, widen as much as they have now. This is actually further enforced by the by the chart on the right-hand side that covers the retail preferred spreads. This is actually a shorter time history, but this goes back to 2012. And since then, the average credit spread for retail preferreds has been around 3.9%. But currently, the spread for retail preferreds is around 7.4%. So again, reinforcing the point that the current valuation from a credit spread perspective is definitely very attractive when we compare to where spreads have been historically. Moving on to the next slide, I want to focus a little bit about the credit fundamentals for the preferred security asset class. If we look at the chart on the left, the first bar is actually showing the credit rating breakdown for the preferred security index, and you can see that it is a predominantly investment grade, index. So for the preferred securities, the exposure to high yield names that is BB or below is actually less than 30% of the index makeup, and the average credit rating for preferred securities is going to be a BBB minus or a investment grade credit rating. If we compare that with US high yield, for example, you can see that the breakdown obviously for US high yield is going to be 100% within high yield names. So the distribution is pretty even between BB and B or below names. So simply from an average credit rating perspective, you can see pretty clearly that from the chart that the distribution from a credit rating perspective for preferred securities is going to be a higher average credit rating than high yield. Another metric that we can look at is actually look at some of the financial ratios. We've chosen the debt to total capital ratio here. Again, looking at the what the average leverage is for the issuers within the respective asset classes. So with the average debt to capital ratio for preferred securities, it's currently averaging around 50.6%, and that is actually quite comparable to US investment grade names, where the average debt to total capital ratio is 55.5%. If we compare that with US high yield, straight away you'll see that the leverage is considerably higher with US high yield, where their debt to total capital ratio is around 85%. So moving on to the next slide, just to talk a little bit about the historical default rates. You'll see that the default rates for preferred securities started the period around 2006, 2007, 2008 was actually quite high. This was largely due to the global financial crisis. It actually predated that period slightly. So we did see a bit of an elevated default rate, but pretty much since 2009 onwards, the default rate for preferreds has actually been very, very low. In fact, if we look at the last 10-year period, the average default rate for preferreds has been less than 1%. In contrast, the default rate for global high yield names has actually been quite high, pretty much since the global financial crisis in 2009. And over the last 10 years, the average default rate for global high yield has been almost 4% over the last 10 years. The other point I wanted to highlight was in 2014, 2015, this was a period where we did see a sell-off to oil prices. In a way, it's actually quite a similar scenario to what we're facing today. And you can see that the default rate in 2015 moved up from 1.9% the previous year to 3.7%, and then was even higher the year after in 2016 at 4.5%. So this just gives you an indication, when oil prices are weak, historically we found that this has impacted the high yield market, the most directly. On the other hand, with the preferred securities market, even though we do have some energy names, the default rate has, kept pretty low, at least if we look back at the 2015-2016 period. Moving on to the next slide, again, we look at the longer term track record for preferred securities. since 2007, and we were obviously, felt quite a significant drawdown with the global financial crisis. Since then, we've had multiple market sell-offs, including the European debt crisis, the taper tantrum in 2013, the energy sell-off in 2015-16 that I mentioned, and the most recent one was the Fed turning to a interest rate hiking cycle in late 2018. Obviously, where we are at the moment with the COVID-19 crisis, I guess we've experienced a very deep drawdown over the month of March. It's hard to say whether we've hit the bottom already. It's been quite encouraging, the rebound that we've had in the market over the last week. But obviously, it's hard to predict with any certainty of whether we have quite reached the bottom at this point in time. But I think I just want to use this chart to say that preferred securities has encountered numerous periods of market volatility, and each time the asset class has managed to bounce back. And I think eventually when we do pass the current situation, I think we will see investors return to the preferred security market. Simply because where interest rates are at the moment, with the Fed cutting rates to effectively 0%, the demand for assets that are going to be relatively high yielding, such as preferreds, will be in strong demand, and we think we have a good case to justify the valuation because of the relatively strong fundamentals for preferred securities. So just to summarize the outlook, going into the second quarter, I think the first point is really the action that we've seen from central banks around the world, including the Fed, cutting rates to 0%. The Treasury announcing a stimulus package of over $2 trillion. This has actually been quite effective from what we've seen in the last week, at least to pause the volatility that we saw during March. The second point is that I mentioned earlier as well. We think that demand for higher yielding assets, especially those that are higher quality, will be attractive to investors once the market volatility does calm down. The third point is that where we see valuations at the moment, we do see quite attractive yields. There was a spread chart that I referred to earlier, but basically we do see strong examples of high quality companies that are rated investment grade, that are currently offering yields of 8 to 10%, and these levels are pretty much at multi-year high levels. So we do think that from a valuation perspective, the attraction for preferreds is actually quite high. From a sector perspective, we still pretty much have a bias towards the US regulated utility market, even though the economic outlook, I guess, has weakened dramatically for the US. We do feel that a more defensive sector such as the US utility sector will actually stand to do quite well. The demand for electricity and gas by households and commercial companies should remain pretty stable, especially now given so many people are working from home as well. We think demand for electricity will serve the utility sector quite well going ahead. Within financial services, the point I want to make here is that from a capital perspective and from the balance sheet perspective, banks are definitely in a far better position than they were back in 2008 during the financial crisis, where they were pretty much at the center of the crisis. That's definitely not the situation that we have at the moment, and we think financial services, given that they are such a significant issuer within the preferred space, should be much more stable than the 2008 period. So the last 2 points is really just talking about the credit spreads. It is hard to say, again, if we have reached the bottom. It is quite possible that we do see more volatility in the months ahead. But we do have, quite strong conviction in the names where we have exposure, that the companies where, that have issued preferred securities and which we have exposure to, we're actually quite confident that we don't expect any coupon deferrals, and we don't expect default within these particular companies. So from a fundamental perspective, we are quite confident in the names that we own in the preferred space. And finally, the last point is that, purely from a credit differentiation, from an investor's point of view, we do expect that to increase. Obviously, as we overcome the initial shock, when itself was pretty indiscriminate, going ahead, we do expect more differentiation from investors, and hopefully, that will support, the higher quality companies, and we think, certain names within the preferred space should, begin to do quite well as investors, differentiate more between them. So I'll stop there and hand it over to Daphne.
Okay, thank you, Dylan. We are going to open up for some questions now. If you join via the webinar platform, feel free to input your questions below the screen. We will take those questions at an asset class level. So for fund-related questions, we'll get back to you after this call. So we see some questions coming here. The 10-year Treasury yield slipped to a record low in March. What is the impact of this on the yield spread of preferred securities? And can you still find quality preferred securities with attractive yields?
Yeah, sure. I think, typically, I think when we've looked at performance in the past for preferred securities, given that it is pretty much a predominantly fixed income asset class, typically when interest rates come down, that actually supports the performance for preferreds. So with the Treasury yield, reaching record lows, that's actually worked pretty much in favor of preferred securities. Having said that, with the widening of credit spreads, that's actually gone against the performance for preferred. So even though, Treasury yields coming down has helped preferreds, but because, we did see a risk-off market and credit spreads widening, that has actually impacted the performance for preferreds. And to your second question about, do we see high-quality companies in the preferred space? I think the short answer is, we definitely do. Given the current market valuation, the yields are very attractive. But if we look at the credit fundamentals, as I mentioned, one example is, in the utility space, where the exposure of the companies to the economic cycle is actually quite low, because these are regulated companies, and pretty much the demand for electricity and gas, will be stable, under any economic environment. We think now is actually quite a good time where we do see quite a strong selection of high quality companies at attractive yields. So we saw there some questions for the sector in general. So just in general, the outlook. Do you think the payout from the preferred securities sectors will remain unchanged or lower in the future, in the coming future? Yeah, I think, one of the previous charts that I showed for the average yield, if I can go back. To slide number 6, actually, which shows the current yield by sector. I think, because we have had a sell-off, you will see that the yield has actually been going up. So I think, if you bought or if you were exposed to preferred securities at the beginning of the year, the yields probably would have been pretty much lower than what we see at the moment. So I think, because of the sell-off, yields are going to be, quite high relative to where levels have been in the past. But to your question of, do we think yields will be lower or higher? I think, it really depends on what happens in the market. But if we do see a gradual market recovery, then I think over time you would see the yield, decline a little bit. But having said that, we'll probably get some total return capital appreciation as well.
Thank you. Another question that's related to the utility sector. It was a good performing sector in 2019, and unfortunately under some sell-off pressure in the first quarter of this year. So do you think this sector will still perform for the rest of the year? And what other areas or segments of the market may offer better growth opportunities in 2020?
Yeah, I think, at the moment, because of the sell-off, I think it's fair to say that the portfolio managers are taking a more conservative view, which means that at this point in time, they're not really looking for, to take extreme risks. They're not looking for the higher beta names, so to speak. And the reason for that is quite simple. There's enough value out there that even amongst the more safe names, primarily within the utility sector, there's enough value there that we think, if we do get more fund flows into our funds, we will probably, at least in the initial instance, use that investments, primarily in the utility space, where the outlook for these sectors are of a more defensive nature.
So there is a question about the oil price correction in Q1. Do you see there is a high chance of default in the energy sector? And at the same time, do you see the crude oil price will remain lower for longer?
Yeah, that's a very, very good question. I think, yeah, I mean, in terms of the long-term outlook for the oil price, I think that's very hard to determine. I mean, obviously there's a lot of components to that. I think, the latest news is that, potentially there's going to be, negotiations between the US and Russia, hopefully trying to, bring them back to the table to negotiate with OPEC. If they do come back to some agreement, that will obviously be positive for oil prices in the short term. But it's hard to say, if there will be a quick recovery, to oil prices, or if they're likely to, remain at a fairly low level. I think what I can say is that, within the preferred security space, with the energy names where we have exposure, these companies are probably in the midstream segment of the energy sector, and their, exposure to oil prices is actually not going to be too direct. So unlike the E&P producers, where their performance pretty much depends on the oil price, the midstream companies, have long-term contracts with producers, and the volatility from their earnings is actually not going to be as extreme. So to the question about default rates within the energy sector, I think it is fair to say that we probably will start seeing some uptick in defaults for energy names, but as I mentioned earlier, it will most likely be concentrated within the US high yield universe, and the preferred securities market we do not expect to be as impacted at this stage.
Okay, thank you very much. We are going to end here. Our sales team will follow up with you for those unanswered questions. We appreciate Dylan's time and everyone's time today. Thank you once again, and we'll see you soon. Thank you.